There you go.
All right, hello everybody. We will get started in just a minute. I know some folks are still dialing in. Okay. All right, and I am recording this call, so obviously, if you're joining today, you're getting the content live. However, there are a number of folks that I know that will be listening to the replay, so we'll go ahead and record this call. So just to get us started. So thank you very much for joining today. This month's discussion with Peer Executive Group will be on employee benefits. My name is Michelle Fisher, and I work with Dan Crowley and Owen Crowley, and I have the pleasure of introducing today's topic and speaker, Don Cooper. So if you were able to join us last month, our focus was on the future of business planning for the future of your business. This month, the topic will be on employee benefits and why key employee retention is so critical to the success of any business. So today, Don Cooper, Regional Vice President of Principal, and his internal wholesaler, Corey Cox, will be leading the discussion. Don has more than 35 years of experience working with business owners, financial advisors, attorneys, and CPAs on planning solutions. Principal has been a wonderful partner with us. They're a Fortune 200 company with more than $800 billion in assets under management, and they are a leader in the business insurance space. So after Don goes, he'll take about 20-25 minutes. We'll do a Q&A where you can either chat your questions or you can take yourself off mute and ask. And with that, I'm going to just turn it right over to you, Don. Thanks for being with us today.
Thank you, Michelle, and thank you everybody for joining. You know, as you know, especially over the period of time the last couple of years with COVID, we've had a lot of calls and a lot of interest from business owners regarding employee retention. And it's not just a matter of giving them money and such. It's really a matter of how do I keep these people in the long term and for a long period of time. Now, when you look at the quit rates, it's really at the highest level since they started tracking these. We've had 3% of the workforce voluntarily leaving. And I don't know if you've seen it on the internet, but there's a whole nother segment of people that are leaving their jobs and putting on TikTok videos and other social media sites about how to quit because they're not happy. Korn Ferry said 38% leave their jobs without even one lined up. We also have, you can also take a look, and we have them also on quit rates based on different industries on a month-by-month basis. So what do we do? Well, you know, we tend to look at a lot on qualified plans, such as 401ks and such, which require the business owner to really put all their employees on. On a non-qualified plan, the employer can decide who can participate. Plus, there are different plans, a whole lot of different types of non-qualified employee retention plans. Now, we're going to go through a few of the common ones today, but there are more than what we're going to discuss now. And the beauty of it is, it's not like it's one plan for everybody in the company. So I can have a company with 10 people and have a different combination of plans for those different employees. And there's even flexibility within each of those plans. So the first plan we want to look at is what's called a bonus plan or a 162 plan. And what I'm going, and when you look at these plans, keep in mind that one plan is not better than another. They're just different with different degrees of golden handcuffs. So what we're going to do is we're going to start to look at these plans from the least strength of golden handcuffs to the most, and who are usually the type of employees to give these to. So when we look at an executive bonus plan, you can pretty much give it to anybody, whether they're a top hat or non-top hat employee. And with the executive bonus plan, the business is really getting a current tax deduction. And basically the way the bonus plan, or they call it the 162 plan, works is that the employer is saying to the employee, look, you're a very valuable individual. So what I am going to do is I am going to give you a bonus, and I'm going to give you a bonus, and I'm going to cover the tax on that bonus, and that net of that bonus is going to be used to buy a cash value life insurance policy. And the reason that it's going to be used to buy a cash value life insurance policy is twofold. It's one, because we want to make sure that we care enough about the employee to cover their family in the event of an unexpected death. But two, it's also going to be designed as a forced retirement savings. So suppose I say to the employee, look, I'm going to pay for this cash value life insurance policy, and the premium's going to be $5,000 a year. Well, I'm going to give you a bonus of $8,000 a year because that's ordinary income to you. And that will net out to the $5,000, and that will be used to pay for a life insurance policy. The corporation will get a current deduction on that $8,000. As I said before, the employee will have ordinary income on that $8,000, nets out to $5,000, and they buy this cash value policy in which the employee is the owner, and they choose their beneficiary. And on the distribution phase is once the bonus agreement is done, they still have the policy. They can take the cash value and surrender the policy. They could take the cash value if they're near retirement and put it into an annuity and have that fund a guaranteed retirement income. One of the nice things, though, is, you say to yourself, okay, I'm getting a deduction here, but really, where are the golden handcuffs? And the golden handcuffs are where we can put in a restricted agreement. And the restricted agreement basically says two things. One is the employer can put in a vesting period into this bonus plan, or on the other hand, conversely, they could put in a clawback into this plan and design it however they want it to be. So you can say, look, if you leave during year one, you owe me 90% of the bonus. If you leave during year two, you owe me 85% of the bonus, however you want to design it, so that if the individual leaves, at least you will get some cost recovery. Number two is, even though the employee is the owner of the policy, we're using it as a forced savings. So the employee is not able to go into the policy to access the cash value without the express written consent of the employer. So basically, you need parental consent to be able to get the funds. and we will not release the funds without that express written consent. You know, there's a lot of advantages with the employee, especially because, you know, they own the policy. And a lot of times this type of a plan is given to the employees that have been with the company for a while, and you're not necessarily afraid of them leaving, but you want to give them a thank you benefit for all the years that they have put into to the company. So a lot of times this is used for those employees that have been with the company for a while, or are maybe up in some of the older ages and are going to be retiring maybe over the next 10 years. So we now get into a little bit of a greater golden handcuffs where we're looking at a non-qualified deferred compensation plan. And that's kind of a generic term where basically what we're looking to do is defer compensation to a later date so that the employee does not have to pay income tax on that immediate amount of money, but will defer it until they either retire or there's a specific date that an agreement is given to. So let me explain what I mean. So you can do, there are plans where you can treat it like a non-qualified defined benefit plan, or you can also treat it kind of like a non-qualified defined contribution plan. So on one of these types of plans, what happens is the employer says to the employee, you stay with me for X amount of time, and I'm going to give you this lump sum. You leave before then, you get absolutely nothing. So it's what we call a cliff vesting because it's an all or nothing proposition. So if we look at this as an example, as a defined benefit type plan, and I say as the employer, look, you stay with me for 10 years and I'm going to give you $100,000. But if you leave before those 10 years are up, you get absolutely nothing. So what we just did is we just created this promise to pay. So number two, how are we going to fund this promise to pay? Well, you can self-insure it as a company to fund that promise to pay. You can invest money in mutual funds or what have you. You can also purchase a life insurance policy where it's a corporately owned policy, so the business is the owner and the business is the beneficiary. So what happens is you work on getting that 100,000 cash value in our example at the end of 10 years. Now, during this 10-year period, it's set up so that if the employee passes away during this 10-year period of time, that the employer will get all the premium back, cumulative premium back as a death benefit. So all that premium would come back income tax-free, and the employee's beneficiary would get the remainder of the death benefit income tax-free. So in essence, when the employee dies, it's set up so that the employer is made whole and the employee's beneficiaries get a death benefit income tax-free. If the individual leaves during that 10 years, they get nothing, and the company can get back can surrender the contract and get back the cash surrender value of the policy. Now, if the employee is still there for those at the end of 10 years and you have 100,000, the employer has an option of two things. One, they could just surrender the policy, get a check for $100,000 and then pay the employee 100,000. Or what most companies really do is they transfer the policy over to the employee. Either way, whichever method you choose, there's three taxable events that occur. Number one, the employer pays a corporate tax on the gain. So if I put in 80,000 of premium and my cash surrender value is 100,000, there is a corporate tax on that 20,000. Number two, to help offset that corporate tax on that 20,000 is that the employer gets a tax deduction on that full 100,000 because that's considered a bonus. And number three, the employee has ordinary income on that 100,000. And the employee has a lot of flexibility because one, they could surrender the contract and pay the tax out of that. So let's say they have 100,000 and they net out $65,000. So they now have this lump sum of $65,000. And the beauty is that there does not need to be any type of separation of service to collect this money. So they can still be with the company. Number two, what they can do is they can pay the tax on that 100,000 out of a separate account and just leave the policy going. They can pay the tax out of the cash value of the policy and just keep that policy going and use that cash value stream for whatever they want, or can transfer it over into annuity for a guaranteed income stream. Most employees will take that, will surrender the policy and take that lump and take the ordinary income out, and now they have this lump sum. So here's the really neat thing about this lump sum. So now the employee has this lump sum of $65,000. So now the question is, to market this to employees and why employees like it is, what do I call this lump sum if I want to market this type of a plan to an employee? Well, if I have a young employee that maybe graduated college recently, I can use that, call that lump sum, hey, here's a way to help you to pay off your student loans. If I have somebody who's an employee who's a bit more established, I can call this lump sum a way to kind of like a 401k catch-up type. If I'm a sole proprietor and I have a key employee or key employees that want to eventually buy into my company, but there's no way they're ever going to be able to afford it, I can call this $65,000 a way to help fund you to buy into my company or buy into my practice using tax-deductible corporate dollars. So even though it's the same lump sum, it's really a matter of what I want to call it. And the other nice thing about this type of a plan is I can have different periods of time and different lump sums for different employees. So I can choose a 10-year payout, an 11-year payout, and so forth. I can choose a lump sum of 100,000, 50,000, whatever you want to choose. So that's kind of where we're getting the defined benefit. We're getting a defined contribution where I set up a budget and I'm going to pay X amount for X amount of time, and I'm going to promise the employee that it's going to grow, and I'll pick a conservative interest rate of, let's say, 2%, and that it's going to grow at 2%, at minimum 2% a year. And on these type of plans, whether it's the contribution or whether it's a defined benefit type of plan, you can put in a performance value in there. So if they're only doing 80% of what their goal or revenue performance should be, then you're only going to get 80% of the lump sum. So, as the employee stays longer in the company, you don't want them just to, for lack of a better way of putting it, just shut down, knowing that in a year or two they're going to get this 100,000. So you want to, you can really structure in a performance payout on something along those lines. So there's really a lot of flexibility to it. Some people give it to their top salespeople, their top administration people who they don't want to leave. This type of a plan is normally given to the newer employees, and because of the different uses of the lump sum, is a great way to recruit new employees, because you're going to promise them a way to pay off their student loans, or a way to maybe buy into the business, or a down payment for a house, all these different things. So a lot of flexibility on how that lump sum is used. And we went through a lot of these different types of flexibility. Another type of plan that is called a SERP Select, but is basically a non-qualified deferred comp plan. Well, this can be paid by employer funds. Sometimes you can use employee funds as well on larger plans. On smaller plans, there's usually not an employee deferral, and it's usually employer funds. But on this type of a plan, there are different vesting options. So not only is there a cliff vesting, like on the Select Reward, where it was the all or nothing proposition, but you can also do a graded vesting, whether it's a 3-year, 5-year, 7-year type vesting. And rather than getting paid out in a lump sum, although that's an option where you're paying the tax all at once, you can be paid out over a period of 3-year, 5-year, 10-year period. But this type of non-qualified deferred comp plan does require separation of service, such as retirement. Now, the thing to keep in mind when you're looking at all these plans is they all have different times that you get a deduction. Like the executive bonus, because you were paying the bonus right away to pay the premium, gets a current deduction. The Select Reward gets a deferred deduction because that's in a lump sum. In the SERP Select, as the money is paid out, whether if it's paid out over a 3-year period, let's say you're paying out, $200,000 a year for 3 years, you get your deduction of $200,000 in year 3, a deduction of $200,000 in year 4, and a deduction of $200,000 in year 5. Now, you can't get hung up on the deduction because that's not necessarily the most important item. Because when we look at, if you look at your employees, you really need to, the question you really want to ask yourself as business owners is, what's more important to me? Is it a current tax deduction or is it control over the employee? Because by definition, I cannot get a deduction until I pay money out to the employee. And once I pay money out to the employee, I'm going to lose a sense of control. So that's why I keep saying that one plan is not better than another. They're different. And that's why I go back when you're going with the executive bonus, you're getting a current deduction, but normally you're not too worried about that individual leaving. And on the select reward, you're keeping them there for a longer period of time and getting that deferred deduction at one time after the 10-year, 11, whatever period of time it is. And on the non-qualified deferred comp plan, you're getting your deduction depending on the age of the individual, if they're waiting for retirement, you know, down the road. But, you know, keep in mind that all of these plans are, in its essence, all of these plans are a promise to pay, whether it's now or whether it's in the future, all a promise to pay. And a lot of companies decide not to self-insure, but use a cash value insurance policy because it acts as a separate bank of money, because liquidity changes years by years. And if you have a promise to pay, you want to know, one, that the money is there, and two, more importantly, or just as importantly, the employee wants to know that there's this separate bank of money. And the fact that you're telling the employee, one, that we care about your family, so we're going to take out this life insurance policy on you, and your family will get an income tax-free death benefit. And number two, that we care so much about you that we're creating this separate bank of money so that we know that the money is going to be there during that time, and that you're not going to have an issue in case we have some liquidity problems, you know, or what have you. So these are all promises to pay at different periods of time. And, you know, a lot of companies use these type of employee retention plans, either in lieu of or in addition to, you know, profit sharing plans and such. I would always tell you to make sure that you offer them a qualified plan first, and then offer to everybody, and then offer the non-qualified plan to whoever you consider yourself to be a key employee. So all these type of plans, we have sample documents. We have, Principal also has CPAs and attorneys who are employees of Principal, who you can speak with at no additional charge also to get some foundation of knowledge. We also do all complimentary plan administration, and we're administering over 24,000 plans at no charge. And we really know what we're doing on these, and we can answer whatever type of questions that you have, and we can speak to your attorneys or your CPAs. Again, this is all designed as a consultative approach to make sure that you know what all the different plans are out there and how all the different plans can be applied to your employees, and which of these plans fit best for your company. So, Michelle, I wanted to keep to my time limit.
Great. I thank you. I think that that was very good information. I have to tell you, when I think about the fact that employees are becoming more and more important because they are leaving the industry, they are leaving their jobs. Employee retention definitely very critical. Very good information. The one thing that I'll mention before I open it up for Q&A is if you are wondering how to take the next step with any of the topics that Don has mentioned today, and I mentioned it at the beginning of the call, we work very closely with Dan and Owen Crowley. So reach out to them and let them know that you're interested in having a conversation with Don or with Corey, with the group at Principal, and they will partner with Owen and Dan to make sure that that these ideas are vetted and set up specifically for your particular situations. So with that, feel free to chat a message through. I'm looking at the chat board right now. Or if you would like to take yourself off mute and ask a question, please do so. Okay. Well, I don't see any coming in. I'll give it another 10 seconds or so. Okay, I don't see anything coming in. So Don, that always means to me that it was a very thorough presentation. And again, reach out to Dan, reach out to Owen Crowley. And if you have questions, they can certainly direct you back to this group here. With that, I hope everyone has a wonderful afternoon and thank you for joining us today. Take care.
Thank you.